So the main goal, you know, is really to be able at the end to write a diagnosis, to present potential and future performance and risk scenarios and forecasts, and of course to make a proposal or to design a recommendation with several constraints, goals, issues, cost reduction, and so on. So this is for the objectives. 4.2, the content, it's, as you know, 15-hour course. It's a short course, and it is divided here in 5 sessions of 3 hours. And this session will take place this week, you know, starting with this first session today. If I move to the second slide here, you will find a few elements on the grading systems and the readings. The grading system is based on 2 different categories of exams and assignments. Final individual exam, it's 60% of the final grade. It's a 2-hour exam. In the documents you received from CAVG, you find past exams, which are good examples of what could happen, you know. Conditions will be the same. It means it's 2-hour, it's individual exam, it's without any documents, and I make generally an exam with several independent parts. Some of them are questions, some of us are so small exercises, you know. And generally you have 5 or in some cases 6 different independent parts. For each part, I gave a grading system again. It means the number of points which will be dedicated to this part, and the recommended time to allocate to each part. We will use some of the past questions and exercises during the course, so it will prepare you for this final exam. The second element of the grading system is individual exercises and cases, you know, for 40% of the final grade. I will give you the exercises in the case during the course after 2 or 3 sessions. Second point here, which is number 4, it's for the readings. It's easy, you know, to identify the chapter pages and documents to read, because you received a book, which is a Birken DeMarzo corporate finance book, and there's chapter 2, which is a good chapter dedicated to financial analysis. So read the financial analysis chapter of your textbook, you know. And I sent you also some documents, you know, detailed presentations of financial analysis courses. What I will do here is more summarize, but it give you some possibility, you know, to go further into the details or to come back to some points if it was not completely clear at the end of the course. So this is for the framework, this is for the syllabus, you know, for this course in financial analysis. As usual, you know, the individual exam will be about 3-4 weeks after the end of the course. You have to check with Tram and Lynn, and we will say when it is scheduled. Perhaps you already know when the exams the exam is already scheduled. So this is for the syllabus, and now let's move to session 1, and I will show you here if I can open it. No, this is not the right one. There's something wrong somewhere. Last one of the slides. System. The specific slide for session 1. I don't know why it disappeared. The slide has disappeared. Okay, anyway, it's not really a problem. I will try to summarize what was written on the slide, but one of my slides has disappeared. Okay. So it was, the program for today, for today's session. After the presentation of the syllabus, we will go through a slide on why, who, and how. Why do we go for financial analysis? Who is an expert who is using also financial analysis, and how? It means what is the degree of complexity? Is it a kind of handmade analysis? Is it using software, for example? Next, we have a slide on accounting and finance, which is a very central issue. Yeah. What are the differences between accounting and finance, and what does it mean here in financial analysis? And then I will start with a presentation of a methodology with several slides. Yeah. Several slides on methodology. And the next part will be on the balance sheet. We'll spend time on the balance sheet with several slides. And then on the main equilibriums of the balance sheet. Slide number 13, number 14. Then we have a small exercise to go through these equilibriums. This is still very simple. The calculation here. And the end of the course will be dedicated to exam questions who are coming from past exams, and which illustrate very well the concepts introduced in this first session of the course. Okay. So my first point is why, who, how. Okay. So why to go through financial analysis? What are the reasons? What are the goals? Is it, as in many other parts of finance, to manage, calculate risk and returns? And it is clear that the main goal is to find, let's put it another way, the strengths and the weaknesses in financial terms, which means mainly the returns or potential returns, and with an S there, I will explain that later, but also the different categories of risk, and particularly the liquidity and the solvency risk. Who is doing that? If you could make a kind of study of survey of the financial analysis made around the world, we will conclude easily that it's mainly a technique which is applied by bankers. And retail banks are probably the first category of bankers using financial analysis. But it doesn't mean that other categories of banks don't use financial analysis. They use also financial analysis, even if it is probably less central. CFOs use financial analysis and develop financial analysis of their own firm, their departments, their subsidiaries, their competitors also. Shareholders, of course, are interested by financial analysis and particularly by the potential returns of the company they are invested in. In many countries now, you find workers, interested in financial analysis because they are also shareholders, or because they want to get some kind of knowledge of the risk for their employment, and the unions or association of workers are running financial analysis to estimate the risk for the workers, in the reduction of number of employment and perhaps in the sale or bankrupt of a firm. But customers and providers are also interested by the risk of their counterparts. The customers, they want to know if their order will be satisfied. If it is an order in 3 months or in 6 months, if the firm will be able to produce and to deliver. And the providers, of course, they want to know if they are nearly sure to be paid by their customers. So, for different reasons, many players in the economic world are developing, running financial analysis, not exactly with the same goals, but always you find some kind of measure of return and risks. How do we do that? Most of them use a financial analysis method. It could be a simple one, and this is what I will present in the next few minutes. Or it could be more complex, particularly in case of complex operation or complex legal structure, like groups of firms or international firms. Anyway, there is a method behind. Investors, or investment funds also, they have their methods, to study the firms they want or to invest in, or they make a proposal to invest to their customers. All these methods have common points, but also they have differences because the goals are not exactly the same, even if some basic dimensions are part of the goals of each player. We should underline also that you still find, of course, traditional handmade financial analysis, made calculations of equilibriums, of margins, of ratios, of forecasts, which are handmade. But today we have also software which are used in many banks, particularly, which at least make basic calculations and accelerate the process and bring some kind of productivity in the financial analysis. In more complex or advanced financial analysis method, we use also forecasts. And forecasts have to be generated generally by software. Of course, software doesn't work alone, but integrates a kind of, I would say, parameters which are given by the analyst itself, like the growth rate, like the interest rate, for example, like the evolution of the stock market, also. So, in conclusion, financial analysis is some is a part of finance, it's a part of corporate finance, it's a part of market finance also. And even if it's not completely standardized, some elements are standardized, some questions are there in all the kind of financial analysis, like returns and risk analysis, even they are not measured the same way. Some others are more specific. In some cases, it's handmade. Some others, it's based on the calculation provided by a software. But anyway, at the end, the conclusion, what I say the conclusion, it's a good analysis, is generally made by a person, by an analyst, and not generated automatically. And after that, we'll see that in a minute, you need recommendations because financial analysis is used to prepare a decision, a recommendation, and this is the which is the element which is brought by a good financial analyst. If you raise the question, what is happening on that kind of on the part of finance? It's of course, more automatic calculation and they use also a method of automatic learning, IA, in order to make comparisons and to accelerate the production of the results, the conclusions. But anyway, you have at least two parts which are not taken into account by all these software and tools of dealing with forecast. It is the first examination of your accounts and the writing, the preparation of a recommendation. So automatic methods, bring some kind of help and productivity, I would say, in the middle of the methodology, but not at the beginning and at the end. So now let's move here to the slide number 4, which is a slide on accounting and finance. Now we have very often the feeling that financial analysis is a kind of last step of the accounting accounts. Should be very careful there because accounting is necessary to go through many development in finance, and particularly in financial analysis. The accounting system is the largest part of the information needed. But accounting and finance are different. And what we do in financial analysis is larger than what can be done only with the accounting data. Why? First, because the accounting system or accounting statements takes into account only past and present information, past and present. It is the past up to now, in fact. Finance take into account also the past, the present, but give great importance to future information. And future information, generally, it's not information, with certainty. It's information which is provided with some kind of uncertainty, probability, and you know that because you have been through, for example, the course of investment decision with Olivier Grosart, and you understand that investors, nearly all the measures are based on cash flows, and cash flows are future cash flows, means they are forecast. They are not known with certainty. In some cases, we have probabilities for different calculation of the cash flows. So it means we have some kind of expected cash flows for make calculation using statistic tools. But it's not, it's not the only data you can obtain through the accounting system for past operation. So finance is a measure between, it's a mixture, excuse me, between measures of past operation up to the present time, using basically the accounting system, and of future information coming from other statement, other forecast, and they are provided with some kind of probability or uncertainty. So we mix two different worlds, in fact. Let's also, this is point 3, but in accounting statements, we apply what we call book value. And book value means it is either the price paid or the total cost. If you have a look to the non-current assets, for example, we do that in a few minutes in the balance sheet, all these numbers, are for investment, let's say production equipment. They are based on the price paid. When you buy an equipment, you have an invoice, you pay the total price, which is at the bottom of the invoice, which includes also VAT, but in your statement, in your balance sheet, we take into account only the price paid without VAT. So you have an equipment, you have the equipment is used in the firm. In the balance sheet, the gross value is equal to the price paid without VAT, okay? But it is clear that on the secondary market, for example, the value of this equipment is not this element. You know that all these equipments, non-current assets, like equipment, at least, are submitted to depreciations, which are supposed, to follow the decrease in economic value of these equipments. But it is, it is a kind of general rule, and it can be very close or very far from the market price of this production equipment on the secondary market. So we are using book values, and book values can be also total costs. Total cost. For example, and we'll come back in detail on that. When we estimate the value of the inventories, we have several cases of interest. The first one is, of course, if you are, let's say, a producer, you're a producer of chocolate. Everyone knows what is chocolate and likes generally chocolate. You buy raw material. You buy raw material coming from producers, and you have an invoice, and you pay the price, and your raw material, in your inventory, is valued at the price of the invoice without VAT. So it is a simple case. But after that, when you work on the raw material, you add several other products, milk, for example, sugar also, and you add also spend energy, you pay workers, so on. So progressively, the value of your chocolate is increasing, and you add to the initial price of the raw material all the other components, the price or value of the cost of the other components you introduce into the product. So it becomes more a total cost approach. I take into account the price of the raw material, but I take into account the cost of the energy, I take into account the cost of the workers, and so on. And I've got a value of intermediate or final product, which is based on the total cost calculations. In finance, point 4, calculations are made when it is possible, because in some cases it's not. In most of the cases, I would say, it is based on market values. Okay, market values is a central reference. In some cases, it's difficult to find the market values, or not have a market, even a secondary market, and you have to find proxies of a market value. But this is the idea. Accounting is more dealing with the price paid or the total cost, and in finance we use market values. Point 5 has means that the value of an asset or a debt, is different in an accounting statement in financial calculation. When you issue bonds, for example, in your balance sheet, you integrate the level of cash which is obtained from the issue, and progressively you decrease this number because you pay back, you repay part of a loan. On the market, when you calculate in finance, take into account in several calculations, and we deal with that in the valuation course. You are not interested really by these values. You are interested by the market value of the bonds. And the market value of the bonds is moving up and down depending on the level of the interest rates. If the interest rates are going up, the value of the bonds is declining. And on the contrary, if the interest rates are going down, the price of the bonds is going up. So you find two different systems to calculate the value of the bonds. In your balance sheet, it's a very simple calculation using the amount of the issues at the beginning, and after that of the repayments. When you use market value, it means if you want to resell your bonds, you are not interested really by these accounting calculations. You're interested by the market value of the bonds. That's the price you will resell your bonds. And this market value is a function of the interest rate on the different issues during the life of a bond, the maturity of a bond. So we have two different systems, and we live, with these two different systems. And very often, the best information we have is coming from the accounting system in terms of quality of information. It means, you use data which are calculated with applying book value concepts. And financial analysis is mainly based on accounting and is mainly using, the book value system. This is the reason why, in some cases, when you have, for example, evaluation of a company, you have a look to the balance sheet, and you make a calculation using methods you probably know, because you have this investment course, like discounted cash flows, and you find large differences. Okay. So of course you can explain. You have to explain that, but be very careful and don't take into account, the elements coming from the accounting system very often used in basic financial analysis as a truth. They are of interest, but you have to compare these values with some other calculations, mainly by market value approaches. You can also, and I didn't mention that here, you can also use what we call replacement values. It means you have a factory. You spend large amounts of cash to buy or to build a factory. And now we want to know, and this is very often used by insurance companies. You want to know what will be the costs if, for one reason or another, you had to build again the factory. For example, if it burns. Okay. And this is, of course, of interest for the insurance company, because when they make a proposal for a contract to the firm running a factory, what the CFO of the firm wants, it's a contract which is hedging the risk of destruction. It means if it burns, of course, you can measure to limit the potential risk of a fire. But if a factory burns, he wants to be insured for the reconstruction of the factory. It means replacement value of a company. You find many publications, articles, of course, on replacement values. You find many articles also in insurance academic, in professional journals, and particularly in some countries which were probably more interested because they have a tradition of insurance, for example, Switzerland or the Netherlands. So market value, book value, replacement value, that's at least 3 different systems of valuation. And this, of course, have an influence on all the approaches, valuations, in finance, but particularly in financial analysis and valuation. Now I want to go through something different, which is the methodology. It is a bit more complex, and we can also discuss, and so you will say, I'm, an expert. I've been doing financial analysis for 5 years, and we don't do exactly what you propose. But admit it's not really completely standardized, okay? But you need some kind of basic checklist right now. When I say basic checklist, it is because what I propose, is for simple firms. It's not for a group of companies. I will say a few words on a group of companies, but this is another question. The first question is, what do you need to start with a financial analysis, a simple financial analysis? What kind of documents, data, and the answer is very simple and common in a large part of the countries of the world and among the financial analysts, and the basis is balance sheets and income statement, at least for 3 years. It means you need at least the last 3 balance sheet and income statement of a company. If you have less than that in terms of information, it's very difficult to start with a financial analysis. The second point, is that these statements, it means, let's say, the 3 balance sheets and the 3 income statements, they are standardized, and a few points are checked on the quality of the accounting system behind, and of course, the information brought by these balance sheet and income statements. So you have a kind of checklist in order, to have short examination of the balance sheet and income statement, particularly the system of valuation. Very often on the valuation of inventories, which is very central. You have to be very careful and come back on that. If you are more sophisticated, it is a more sophisticated company using, for example, derivatives, or using alternative financial resources like leasing, for example. Okay, so you have to check a few points of importance, and to validate the fact that the statements show a sufficient quality to be used in financial analysis. This is, in many cases, completely forgotten, particularly in banks. Just because, they receive the balance sheet and income statement, and they introduce these statements into a software, and they ask the software for a certain number of calculations. This is clearly a mistake, this is clearly a mistake. And this step number 2 here is very central, and can be made only by a financial analysis. This cannot be done by a software, whatever the quality of the software is. After that, we have balance sheets which are simplified, which are standardized, and in general, which are organized in 8 different parts, both sides, it means right and left side of the balance sheet. And point 4 here, we try to deal at that point with equilibriums. I will come back on details in 11 calculations on that, which are, we have 3 main equilibriums in financial analysis. The first one being what we call the net working capital, the second one the operating working capital, and the third one the cash position. You see that on my slide, and I will simplify these words using 3 letters, at least for the first 2 elements. What we do, of course, is point 5. We make the calculations, and we are mainly interested, by the charges, by the modifications, and very often they are marginal and not of great importance for the diagnosis, but in some cases you have major modifications, and in that case they are calculated, explained, and discussed, because it can be because a new risk has been incorporated by the firm, or because on the contrary they have sold a new product which is very profitable. And then a few basic ratios are calculated, explained, and discussed, and I give you here the 3 main ratio which are used: the net working capital divided by the sales level, the operating working capital divided by the sales level, and the net working capital divided by the operating working capital, which means, and we'll come back on that in 2 minutes, what is a part of the operating working capital which is financed by the net working capital. Well, if you are not very familiar with that, I will come back, don't worry, on these elements. So we had already in this methodology 6 points to go through, and I move to the next slide to introduce, the second part of the methodology, dealing with the income statements. And when we deal with income statements, we are first mainly interested by a few margins, which are calculated into the income statements. The first one being the EBITDA, earning before interest, taxes, depreciation, and amortization, and this is what you are supposed to use now with the IFRS system. It's not anymore the US based system. The earning before interest and taxes, and the net earnings, with the split between retail earnings and dividends, and I will come back on that with the impact of this decision on the financial analysis, of course, and on the financial resources, financial structure of the firm. Point 8, you discuss, you calculate, explain, and discuss the modifications of these margins. This is central point of the diagnosis. It is clear that a firm with regular recurrent increase of these 3 margins, is in a positive track. If all these margins are declining at the same time, there is something wrong somewhere, either in firm and the policy which are enforced, or also in the environment. It could be something coming from the financial environment, interest rates, for example, or new regulations. It could be also, different behavior of the consumer, or customer in general. So all these modifications, marginal and major, are calculated, are explained, and are discussed. Point 9, after the balance sheet simplified analysis and the income statements simplified analysis, we move to a few basic ratios. We apply, let's say, a ratio methodology. On the income statement, we use mainly, as we did for the balance sheet, three main ratios: net earning of sales without EBITDA on sales, EBIT on sales. And when you are there, point 10, partial conclusions can be written, taking into account all the consequences of calculations that have been done with the standardized balance sheet and income statement. So what you have on these two slides is the basic information you need, plus the check for quality, the balance sheet approach, the income statement approach. And you understand that doing that, we use calculations of equilibriums, we use calculation of margins, we use ratios. That's what we do in this simple methodology. Then, when you are there, you can come back on the first part, which is a ratio analysis, which of course will include what you have already done in terms of ratio approach. But you will try to compare the ratios obtained by the calculation from one period to the next one, to the others, and explain the increase and the decrease. Remember that the decrease in the value of a ratio has not the same meaning for the different ratios. In some cases, it's good news if a ratio increases, or returns ratios, for example. In some of the cases, it's generally bad news, for example, for inventory ratios. So you have to be very careful when you make an interpretation. What do we do? What are we looking for? Point 13 here. We are looking first for solvency and liquidity. And the question behind, and we'll come back on the ratio here. The question behind is this company, liquid? It means what will happen at the end of the month? Do you think that this company will be able to pay the wages and to pay for the invoice of the providers and to pay the taxes which are supposed to be paid this month? But you measure also solvency, which is, same kind of question, but with a different horizon, something like 1 year. Okay. What do you think of the situation of this firm in the next future? Sometimes you find firms with liquidity problems because, for example, the customer didn't pay. But when you have a look to the solvency situation, it's not so bad. It means in 1 year, if the company is not dead because of this very short-term liquidity problem, probably the cash position will be quite good. But very often you find the liquidity and solvency position which are connected. It means when the firm has should difficulties, in terms of liquidity in the short run, very often, you find also expected difficulties for the end of the year. Second, what we try to do in this basic methodologies to measure some returns. The problem of returns is that there is not one return. The problem is not the problem of measures. We know how to measure that quite correctly. But we have different returns. And the problem is, what is the most important one? Or do we need at least a sufficient performance on each dimension? The three dimensions being the returns for the shareholders. The shareholders, they invest their own cash. It means they get share, they are shareholders. They own the equity. And the problem is the problem of return on equity. Now you have also a problem of return on investment, assets, if you want to simplify. And the return on investment is something what's interesting because it can be measured by two different ways. The first one is a measure using ratios, traditional financial analysis. And the second one, you know better. It is using decision criteria, investment decision criteria, based on using cash flows, terminal values, discount rate, that kind of tool. But you have also the problem of sales, operations returns. Each time, you enter a new market and you develop a distribution network and sell products to new customers, what is we should calculate and get an opinion on the return of the new sales. So return of sales is also important. Of course, all these returns one way or another are connected. But anyway, you can have, in some cases, very good returns for shareholders. And for example, declining returns of sales. You find that kind of contradiction or apparent contradictions. You have to solve that. The third point to be analyzed is debt, financial debt, of course. It is financial debt structure. What is the maturity of the debt? You have mainly short-term debt. You have also medium and long-term, and an equilibrium between the different maturities, which means an easy situation to pay back and to pay also the interest. What about the repayment capacities? So you have one way or another to compare, the potential future cash flows and the elements which are included in the contract in terms of repayment, in terms of interest. And last point, which is very often forgotten in financial analysis, it is the debt capacity problem. You have a structure, you have a level of debt, you have contracts and a repayment schedule. But are you able, to issue new debt, obtain new loan from the banks in the near future? If, for example, there is an opportunity which is offered to you. So that capacity, which is a very central and important idea will deal with the sizes on debt capacities. And you understand, you just think to what's happened, in the simple terms, but debt capacity is, of course, connected to the structure and the repayment and so on, but is also connected to the level of total equity and also connected to the level of cash flows, which are supposed to be produced in the next few years. We want also, still point 13, we want also to deal with the quality of operations. It means it's right to have an opinion at the end of solvency, liquidity, returns, debt structure, repayment, debt capacity. But we need to have a kind of at least basic opinion on inventories and the cost of stuff. The inventories is in some economic sector a large part of the balance sheet. And when you reduce the level of inventories, you reduce the cost to finance with inventories. And you increase also the possibility to use these financial resources for other purposes, investments, for example. And the cost of staff, is a basic idea of productivity. You need to reduce the cost of staff, but at the same time, you need to offer, wages, premiums, and other kind of payments, incentives to the staff if you want them to be productive, to increase their productivity, and also to keep them, because on the competitive human resource markets, you are always looking outside what could be the best proposal for them. The quality of operations can be at least partly measured and managed using ratios, and this is very essential for firms. So at this point, you have introduced other measures, criteria, questions. And as you see in point 14, 1 and 4, you are able to have a second partial conclusion. And all these partial conclusions should be written. It's not something, you just present, in a few words in one of the board meetings or conferences. Of course you do that, but you have to write them clearly. And all these conclusions of financial analysis, the words are important. It means the conclusion should not be long. They have to be really well prepared and written. So now let's go further to the methodology 4 slide. And you understand that after a few words on the information needed, the free balance sheet, the free income statement, the check for quality, after the analysis of the balance sheet, after the analysis of income statement, after what we did in the slide number 3, which is mainly based on the ratio analysis, we can do some more. And some more means what? Means what? It means first, We will go through what we call, and I will go into that process in detail. We use what we call a DuPont analysis. And DuPont analysis is a kind of analysis of trying to explain the connections between different management decisions and calculations. I mean, if you have an increase in your inventory on sale ratio, what is at the end the impact on the returns? If you have, a high debt equity level, what are the consequences, on the risk of liquidity risk, and solvency risk? And we can get at least the first element of analysis using a series and connection between different ratios. This is what we call the DuPont analysis, because it was first, presented in news by the DuPont company, which was a chemical company in the US. So I will go into the detail of that. It's very simple. You will understand that very quickly. Probably more important, this is point 16, and point 16 is a cash flow table. And a cash flow table, should be designed to understand the cash structures and modifications in the firm, and to identify another way the liquidity, solvency risk, and the potential capacity to finance new investments. So now, progressively it has been harmonized, and we have what we call a cash flow table generally, which go from the sales level up to the modification of a cash position in the balance sheet. And this is very, very useful to understand where the cash is coming from and where the cash is going, allocated, I would say. Remember that all what we say is a kind of technical approach. And at the end, what is important? Only two things are important. The first one is cash. Do you have enough cash to survive? Do you have enough cash to finance your new project? And the other one is what? Market value. What is your market value? What's happened if you're trying to sell your company or to transfer some assets? Do you have a market value which is sufficient to buy a competitor? Do you have a market value which is in line with your level of operations and your competitors? So this is very central. And when you move from traditional financial analysis to valuation processes, M&A, you will need cash flow tables. So that's the reason why I say a few words about right now, even if I will not deal with these cash flow tables today, because at the time we have courses on valuation and the course on M&A, you will use these tables in order to obtain the necessary information on the cash policy and modifications of a firm. Now you have got a number 17. And number 17 introduces you to something which is different, which is processes, or methods, which try to give you a grade. It's generally a grade which is on liquidity. We call these approaches scoring functions or scoring method. They are based on past analysis, and past analysis are used to structure, to design a function, which give you kind of approach of the measure of the liquidity or solvency risk of a firm you analyze. I believe that at least some of you have an experience with this function because, many banks today use a scoring function to at least find the first kind of automatic generation of risk calculation of a customer. In fact, when you think to what we do in the world, scoring function is a short and nearly automatic generation of risk analysis, which can be developed through using more complex tools. And this is the case of this is what is done by rating agencies, and rating agencies are very central on the markets. They give to all these issuers of bonds, whatever they are, public or private, they give them a grade, and this grade is the equivalence of a score. It is a measure of the risk that the issuer will not be sometime later able to pay the interest or repay the main part of the loan. And if you have a look to these very well-known agencies, we have three main large agencies in the world, which are Moody's, Standard & Poor's, and Fitch, they provide the market, the issuers, the investors, with two categories of scores, grades. The first one on short term, which is liquidity, and the second one on medium term, which is solvency. So this is another way, to find measures for liquidity and solvency risk. So I will come to the details of this calculation and what it means. Of course, it's not a kind of analysis without any mistake. But anyway, it is a first element, of analysis of liquidity and solvency risk. So when you have done that, you have improved again your analysis, and you can extend, all these new processes which are incorporated into my point 17 with new categories of approaches which are more scientific. Just one or two words, terms they exist. The first one being what we call AI, artificial intelligence. And artificial intelligence is using the past. They have a large databases with artificial intelligence software, and they use these databases
comparing your the element which are measures in your firm, meaning through the income statement and the balance sheet, and to give you some kind of measures of the risk, or returns, and the future. And of course, you have other more scientific approaches which are now coming on the market. For example, what we call neurons, Neurones, which is coming, from other kind of fields, but applied to the analysis of the financial situation of firms. So on this point 17, starting from the scoring and the rating, including modern technologies, using artificial intelligence and neurons approaches, there is a new world which is coming, and probably what will be presented in a course like this one, in 5 or 6 years from now, will be very different, because these approaches using AI and neurons will be very central in the financial analysis. Point 18 is on the SWOT analysis. The SWOT analysis can be added to better understand the business model. If you want, to give a kind of reasonable presentation of the conclusions of financial analysis, you need to understand the business model. Business models are very different one from the other. You cannot, ignore if a company is a trading company or is producing cement or steel or cars or petroleum. That's completely different world. And this should be taken into account. And the SWOT analysis, will help you to take into account, to introduce into your analysis and your conclusions, the real world, I would say. You know how to do a SWOT analysis. You have seen that in your past courses. So it is an element of analysis which is very useful just before you write the diagnosis, which is point 19. So what is a diagnosis? If when you don't know what to do with all your calculations and first and partial conclusions, my recommendation is the following one. Identify the main strengths and weaknesses in financial terms, not as it is SWOT analysis in some kind of general strategy terms, in financial terms. Means, for example, you can demonstrate through your calculation that the return on equity, the return for shareholder, is going up regularly. But that on the other side, the return of a new investment is decreasing also regularly. Which means probably, that the firms has known in the years before your analysis a very good and profitable period, but the future years will not be as good. You should also have a look at the inventories, and for example, you can find that there's a better policy of reduction in absolute value, but also compared to the sales level of the raw materials. That means, that the relation of connections between the orders, the delivery, the payments, the
operations using these raw materials have been improved, and then of course the amount, for consequence, the amount of raw materials you find in your balance sheet has decreased, which is good news. But on the other side, perhaps you find a decrease in the final products amounts in your inventories. It has decreased in such a way that now there's only the possibility to deliver the final shopkeeper for the next 2 days, which is not enough taking into account the condition of transportation. So sometimes, these are also in the level of some part of the inventory is not a good news, because that means that customer will come to the shops and they will not find your product and will probably buy another one. So a diagnosis should be very clear, underlying the man's strength and the man's weaknesses. And of course, you have to present it, to be able to present it, in an oral presentation, but also to write. And it should not be only ratios. You have to be able to write a few sentences clear for the readers. Very often when you present a financial analysis, in front of a committee, but some of you know that very well, you have the information of the order to prepare a financial analysis at 6 o'clock in the evening, and you know that it is to be presented in an oral conference at 9 a.m. the following morning. And at 9 a.m. you have to be able, to present a written note with your diagnosis, and also to present the main elements which has driven to this diagnosis in 8 or 10 minutes, oral presentation. And of course, if at the end of the whole presentation you don't say there is no conclusion, the chairman will say, okay, you know very well this firm right now, because we spent hours last night on that firm. What do you think? What is your recommendation? So a diagnosis should always be followed by a recommendation. Recommendation in the bank could be, this customer, all the villains here have identified last year. They are now not so good. Performance are decreasing. Risks are increasing. And my recommendation, is to limit the level of the loans brought to this customer. Or on the contrary, you can say, this customer is in the biotechnology sector, and because of the pandemic, but also because, of trends in several application fields of biotechnology, they are more and more each year on a very positive and growing track. So I recommend not only to increase our loans to this company, but also, if it is possible, to buy shares of a company and to recommend these shares to our customers, which are looking for advice of our portfolio managers. This is very central. The most important part is not calculations. Calculations are tools. Calculations cannot be goals. The goal is really what you are able to do to present in these point 19 and 20, your diagnosis and your recommendations. It has to be at the same time very professional, but also easy to read, easy to understand in a short oral presentation. You don't need, 20 pages. You need to underline the main points and to prepare to bring the elements of decisions to the member of the board. You need a few lines, or you need 8 to 10 minutes presentations. So you have to know all these methods, cash flow tables, DuPont, scores, ratios, equilibriums, and so on. But the main points are there, 19, 20. And the quality of your expertise at the time of you will be graded will be based mainly on the quality of your diagnosis and your recommendation. So, this is the basis of the methodology. And this is what you do each time you have a financial analysis to go through. Sometimes you just use my slide 1, 2, 3. In some other circumstances, you use also part, at least, of what is presented here on slide number 4. And of course, in terms of interest, if you are interested in financial analysis and finance, or you want to become an expert in financial analysis, you have to invest in the knowledge of these new trends towards, an increase in the use of scoring functions, rating, artificial intelligence, neurons, and of course, cash flow table. So this is basis, but I've got another one here, which is the last one on methodology. You can use also some other elements or some other approaches, because you have more and more among your customers or among the firms you invest for your customers or with your own portfolio. You have complex groups. In your country, mainly family-owned or state-owned companies or groups. Very often they are diversified, which makes the situation more complex. Well, that means you will need at the same time to make individual financial analysis. If you have a conglomerate in front of you, working in the textile sector, but also, in the energy sector and in the financial sector, of course, you need individual financial analysis, firm per firm, economic sector per economic sector inside the group. But you need also to have, an analysis of the group as a whole. That means you need consolidated accounts. Consolidated accounts which integrates all the assets, debts, and operations of a group of firms. You need all that. So consolidated accounts is more and more used, and they are more and more published. In many countries now, if you are listed on the stock market, you are obliged to publish consolidated accounts taking into account the international standards. This is very central. You need also, second part here, to present comparisons with standards or competitors or similar firms. I've been working for years in a well-known company, at least in Europe and in America, which is Danone. It's a dairy product company. It is number 3 in Europe. And what do we do in terms of financial analysis? We had identified, a list of what we call important ratios, and about 12 ratios. And we were following this ratio in comparison with the leader of the dairy products, which was and still is Nestlé. It means the target was to each of them to do as well, at least, as Nestlé. So, comparison and to competitors, to leaders, the choice of standards can be also averages in an economic sector, or the comparison with similar firms, are very central. It's very difficult to say, what is the value of the result of a ratio. For example, particularly when you try to estimate the importance and the value of a ratio on the operations, which is generally something divided by the level of sales. It is clear that it cannot be the same in different economic sectors. If you make an analysis in trading companies, generally, they are very small. On the contrary, the return on equity can be very high. But if you compare, for example, to luxury firms, they always have, ratios of operations on sales are very high. And you cannot compare a luxury company and a trading company. And you cannot say, luxury firm I know very well has done 4 times, better in terms of return on equity or in terms of return on sales that my trading company. So be very careful, you have also to make comparison with similar firms. In this point 21 also here, we have a few words, on 2 forecasts, which are very useful at the time we go through recommendations. The first one is a financial plan. But to make a financial plan, we go through that kind of problem in the diagnosis and financial policy course. You need, of course, before an investment plan. There is no financial plan, so there is no investment plan. But this is very central because you can conclude very often easily if the firm you analyze, taking into account, the classical financial analysis approach, is able to meet the financial requirements of a financial plan. It means to find the financial resources, needed to finance the investment you have identified, which has been identified in the investment plan. So financial plan is also a key for good recommendations. And another way to analyze, the liquidity and solvency position is a cash or treasury plan. What will be the inflows and outflows of the company in the next few months? What about these flows? If I make after that, calculations of the differences between these inflows and outflows in the next weeks, months, depending on the kind of company, what will happen? It's another way to have a good feeling of the potential liquidity and solvency problem. But and this is what we will see in many other parts, on many other parts. You have two approaches to deal with cash and treasury problems. The first one is through ratios. The second one is through a cash treasury plan. And for bankers also, it could be through the analysis of the movements, cash movements in the accounts. That is what I said also on the investment returns. You can have an approach through using ratios, but you can have the approach you know very well, which is using a net present value and rate of return, profitability index criteria or payback criteria. Two approaches. And it is true that it's always easier to have a good feeling and a good answer to a question you have when you can find the results using different approaches, just because you know that all these approaches don't take into account all the dimensions of the problem and also use different data with using or based on different hypotheses. Okay. So this is what I wanted to present today on the methodology. We'll go, of course, into the details of all these points in the days to come. And we'll try also to extend some points, the elements I brought in these 9 first slides of my today presentation. I recommend you read. There is a paper which is in the documents you receive on financial analysis methodology. Read that again. It's very similar. It's not completely the same presentation. Give you also the possibility to raise questions. But do that. This is important. And my last advice in whatever you do, don't use a software to which is supposed to go through a financial analysis without before checking, the data you introduce into the software. If there's some problems involved, some mistakes also in the balance sheets and in the income statement, these mistakes will be integrated in the calculations and at the end incorporated also in the results you will use to write your diagnosis and present your recommendation. Okay, this is my first part today, that is I wanted to show you. The second part will be in a few minutes on the balance sheet. But between the first part and the second part of the presentation here is to have a short break. So, I think it's 40, for you it is 2040, I think. 8:40 p.m. For me, it's 3:40. Let's have 10 minutes, and we'll come back and start with the balance sheet. Thank you. L'avion est un de décollage, à peu près. L'avion, 15h40, c'est l'heure normale de départ. Yeah.
On peut se couper.
Je pense qu'il faut se séparer en même temps, parce que c'est pas pour se taper. C'est là que je peux tirer la question. Surtout dans les parties qui sont dans l'eau.
Hein? Ah oui, c'est de l'huile.
Okay, I think it's time now to start for the second part of session number 1 of this financial analysis course, which is called FA1, in the program. And we will start in the second part with a balance sheet, and we have more time. We move to the equilibriums and then to a few questions. So the first element here, which is presented, but some of them know that very well, some others are not very familiar with that. It is a balance sheet structure. And balance sheet structure is divided, in, I would say, categories. And the first categories here on the asset side is the non-current assets, followed by the current assets. Be very careful. The order can be different according to the countries. The American way and the European, for example, are opposite. That means you can start either by the non-current assets, like the goodwill, the plants, the equipments, and at the end, the bottom, you have the bank and the cash, or you can start by the bank and the cash, and at the end, find, the goodwill, the intangibles, and so on. So it's just a question of presentation. All the data, all the even the accounts are the same. Let's say if there is a trend, I don't know, it's really a trend, but it's more and more that kind of presentation to be defined. It means I would say, the US presentation now is used by a minority of countries in the world, where the impact of the European and some other countries like Latin America, some Asian countries also, like India, is dominating. So this is what you find. So now if you go into more details anyway, you have two categories: current assets, non-current assets, whatever the order is. In non-current assets, you find here in this simple presentation, I would say a segmentation between two main categories of non-current assets. The first one is land, plant, equipment, production equipment, transportation equipment, research equipment, and this is the classical elements. Most of them, I say most of them because you have the exception of the lands, are depreciated each year. It means they are introduced, taken into account in the balance sheet, as we said before, for the price paid without VAT, a new plant, a new equipment, a new car, a new lorry, and so on. They are valued according to the book value system, which is the amount paid, the amount at the bottom of the invoice you paid without the VAT. Okay, so this is the first category. You have got the exceptions, very specific case of lands, because lands are not supposed to disappear. But you have an exception, which is the exception, for example, of the mines. If you destroy the land, after that, there is no more land. So it has, it's not depreciation, but it is amortized according to specific rules. We'll come back tomorrow on that problem. The second problem, which is much more important in non-current assets, is the problem of intangibles. And intangibles, you have several categories of intangibles. You have patents, for example. We are talking about the virus and the vaccines today, and Pfizer and Moderna, which are the best vaccines, they are protected by patents. It means, the companies have the right to have a kind of monopoly on the production of these vaccines for a certain number of years. And this is justified by the amount of research they have invested to design the new formulas of these vaccines. So it is clear that the value of a patent today for a vaccine against the COVID-19 is very high in terms of market values. And probably what we will find in the case of Pfizer is much lower than the market value of a patent. And it is also very difficult to find a value for that kind of asset. You will find also in many companies today in intangibles, the brands, you are Nestle, you have Nestle is a brand, Nestle name is a brand, but you have Nesquik, you have several other brands based on the Nestle names, like Nescafé, and all of them have a tremendous value. That means if you compare the market value of Nestle listed on many stock markets and the value you can calculate according to the number you find in the balance sheet with a difference, which is a very high difference. The market value is more than twice the book value of a company. Why do we have this difference? First, because if you create your brand scratch, which is the case for Nescafé or Nesquik, these brands are not supposed to be an asset in the balance sheet of Nestle. They have been taken into account through the income statements, through advertising costs, promotion costs, for example. So they have disappeared, in fact. Okay. And in the intangibles brands, you find in the balance sheet of Nestle, you will find only the brands which were bought by Nestle. Nestle has bought some brands in different industries. And in that case, they are incorporated into the balance sheet of Nestle at their level in the balance sheet of the companies bought at the time of the acquisition. So for successful companies, particularly for companies in the economic sector with very well-known international brands, the intangibles are undervalued. You have also a problem with goodwill. What is a goodwill, basically? A goodwill is what you accept to pay when you buy a company, you make an acquisition, minus the book value of a company. That's if I pay for a company $100,000, and in the book of this company, the company value is only 40,000. I mean, I accept to pay 60,000 more. Not because I'm a very nice person, but because I think that through the policy I can enforce and through the synergies I can obtain from the acquisitions, a price of 100,000 will show a good return in a few years. So, this goodwill, is an asset at the beginning. But of course, the goodwill can either be reduced if you are not successful, or can increase, in fact, if you are very successful. But in the balance sheet as well, we take into account the decrease and not the increase. I mean, if you are a successful company, making very good acquisitions, which accept also to pay high goodwill, but able after that to bring synergies, new management, to drive the merged company, new merged companies in such a way that profits grow quicker than expected, the value of the good will increase, but this will not be taken into account in the accounting system. That means modern companies, particularly in new sectors, economic sector, information system, luxury, biotechnology, that kind of thing, you know, you will find more values for brands, more problems of valuation of the goodwills also, and less percentage, a smaller percentage of the total of the non-current assets for classical equipment and factories. And of course, as a large part of the brands has been developed scratch, the value of the brands in the intangibles has been undervalued. It's undervalued because of the goodwill, it's undervalued because of the brands, and globally, you know, the non-current assets are undervalued. The percentage of equipment, plant you find in the non-current assets in the balance sheet is much higher than in the real situation of the firm. So you have to be very careful about that. Second, you find current assets. And current assets, you know, it's first inventory. I said a few words already on inventory, you know, we come back to details of the measures and how to value that. But inventory can be very central in some economic sectors. If you have a look to building companies, those companies, you know, which are building offices or flats, in the central part of Hanoi or given city, you know, have a look to their balance sheet. You will see that the percentage of inventory in the total of the balance sheet is very high. Because, you know, they are at the moment, they are in the process of building a few more buildings, or do more apartments, flats, and these elements which are not sold are in the balance sheet. They are intermediate products, if you like. And in many balance sheets of building companies, inventory is about 50% of the total. It means a large part of the problems of measures is concentrated in the inventory. Well, what is the value, you know, of a building which I suppose at the end to have 10 floors, and if this building at the end of your N has been the construction has been completed for 3 floors and a half. What is the value there? It's even difficult to know exactly where we are. Is it 3.5, 3 1/3, 3 2/3? So exact numbers are difficult to find. And after that, this is based on the cost of the elements which are in the building, which is not even built at 50%. This doesn't have a market value. It just have a value of components, you know. So this is very artificial, in fact. On inventory, remember also that in some economic sectors, you know, firms are selling the products they have made, but also they offer to their customers a large portfolio of product which is not of their own. you produce chocolates, for example, but you produce only certain category of chocolate. For other categories, you buy them to some other companies and you resell them, but you make an offer which is very large, a portfolio which is very large to your customers. That means for part of what you sell, you can be ranked as in industry. For the other part, you are a trading company, commercial company. And the problems of valuations are different. Okay? So in many activities, particularly those with two dimensions, the first one being a producer, the second one being only a seller and distributor, you find specific valuation problems. I go down here and let's have to look together a look to the accounts receivable. Accounts receivable can be also very important. It depends on the activity and depends mainly on the credit you accept to give to your customer. Very often it's mainly a tradition. You know, in some industries, we have a tradition in different countries also of credit given to the customer of 30 days, 60 days, 90 days, as we say. It means the product is delivered, the invoice is accepted, but the payment is not there. The payments will be delayed, and the customer will pay in 30, 60, 90 days. So in fact, you know, the producer or the seller is a bank in that case. And you find accounts here which summarize the total of the credits which has been given through different invoices, negotiations, and contracts to customers. A very important difference, what we have seen before in the upper part of the balance sheet here, is that all the preceding lines are without, I say, VAT, value added tax. For accounts receivable, it is the contrary. The accounts receivable value are calculated with the value added tax. It means if you sell a product to a customer for $100 with a three-month credit, but a 10% VAT rate, what you will find here in the accounts receivable position in the balance sheet is 110. So be very careful because this has an impact on the ratios we will calculate tomorrow. And I will explain why you cannot divide an amount, whatever it is, without VAT by an amount with VAT, or the opposite. You have to check that there is homogeneity in terms of VAT in the numbers you compare. The others points don't need any expectations. So you have now, we dealt with the left side. You have a problem on the right side of the balance sheets. And the right side, you get two categories here. Traditionally, you get equity and liabilities. So equity is quite easy to understand. It's total shareholders' equity. Equity belongs to the shareholders. Okay. And I will come back on that later in details. But you have mainly two categories. I say mainly. Two categories of equity. First, the cash, which has been brought in the last years by the shareholders. If you are a shareholder, you decide to invest in equity in a company. And generally, what it means, It means that the company is making an issue of shares and you buy the shares. And in terms of accounting system, there is an increase of the equity and there's an increase in the cash position on the other side. The second case, or second approach of the increase of equity is an increase in retained earnings. And this is coming through the net earnings of the preceding year. At the end of the year, the net earnings, and we'll come back on that also, is split between retained earnings and dividend. In parts of the net earnings called dividend is distributed to the shareholder. This means also that you have a reduction in the cash position of the firm because you have to pay the dividend. So it's an outflow from your bank account. The other part, retained earnings, is part of the net earnings, which is kept into the firm and which increases the total equity level of a firm. So when you have total equity, very often you find the detail which is equity and retained earnings. Total equity in the balance sheet is 100. For example, equity is 40 and retained earnings is 60. What does it mean? It means that over the years, shareholders brought 40 of cash to the firms in equity. And that because of a decision of the board, 60 of net earnings were kept into the firm, and have been accumulated in total equity. If you have a look to very profitable firms, for example, some of the firms you know very well in the information system like Microsoft, Apple, some others, you will see that the total level of retained earnings is much higher than the total level of equity. That means the total equity is made mainly of retained earnings. Why? Because these firms are so profitable that each share, they bring to the equity a large amount of the net earnings, which are also very high. They don't need to make equity issues. So progressively, the percentage of total equity coming from retained earnings is increasing. And the cash brought by the shareholders in the sense is a minority of the total equity. So we'll do some exercises on that because you have to understand that very, very clearly. After that, we find non-current liabilities. Non-current liabilities, we have many long-term borrowings. Long-term borrowings are coming from two categories. We divide generally these long-term borrowings between bank loans and bonds issued on the market. We have two categories. What's happened at the moment, it is clear that if you have a look to a worldwide position, and I don't know if worldwide analysis has really a meaning because you have so many specificities in the countries. But anyway, give you an idea of what's happened, If you have a look, you understand that if you make analysis of the last 10 years, the bond issues in terms of percentage of long-term borrowings are increasing. It means firms, even medium-sized firms, are using more the financial markets to obtain long-term borrowings through issuing bonds. and they reduce their position in the banking system. This is very clear in the US. If you have a look at what's happened in the US, globally in the US, not the large firms, globally for all firms, about two-thirds of long-term borrowings are brought by bonds issued in the markets, and only one-third by the banks. It is just the country in Europe. It's one-third, two-thirds the other way around. Okay? But you have also specificities even in Europe among countries. Anyway, there's a trend there, which means, there's a competition which is brought to the banks, to the banking system by the market. Short-term financial debts. We have to come back on that. We have two main categories. It is said here, accounts payable. And accounts payable is part of the operational debts. It means to make a distinction between operational debts, which include accounts payable, which include taxes to be paid, which includes also debts to the staff. And on the other hand, we have the short-term financial debt, which is entirely short-term banks, or it could be also, but it's a minority generally, short-term debts on the markets, obtained on the market. Anyway, the main distinction is between operational debt and financial debt. Short-term operational debt, short-term financial debt. Short-term operational debt are debts to the providers, to the staff, and to the tax administration. To the tax administration is mainly VAT. To the staff, you are always in a company have debt to the staff because they have a right for holidays. For example, they accumulate rights of holidays every month. And you have also another debt to the staff. It could be premiums, bonuses, are calculated on a monthly basis, for example, but paid at the end of the year. That happens in many banks. And of course, you have debt to the tax administration, VAT, and other taxes, but mainly VAT. So that's the main points we have. Again, be very careful. All these numbers, with the exception of accounts payable, and accounts payable, it's debt to the providers, are without VAT. Accounts payable are incorporated in the balance sheet with VAT. But in the balance sheet as a whole, you have only two elements which are integrated, incorporated with VAT included, which are on the left side receivables, on the right side accounts payable. All the other elements are without VAT. Okay. So this is what I wanted to show you here. Let's have a link. Oh, of course. So what you need after that to make an analysis is a simplified and organized structure with a few categories. You need, to simplify this. And if you have a look here, what's happened? If I have a look to category B here, 3B on slide number 12, you understand that we will make segmentation between shareholders' equity, clear. Long and medium term financial debts. So the problem is to define short and medium and long. And generally, in all the international analysis, the difference is less than 1 year and more than 1 year. It means long and medium financial debts are all financial debts to the banks, to the market, for more than 1 year maturity. And you have a line also for short-term financial debt, and nearly at the end here, which are also debt to the banks and to the market for less than 1 year maturity. And you have operational debts, including these debts I mentioned, debts to accounts payable to the providers, debt to the staff, and debts to the tax administration. So that means the equity and liability side can be summarized into 4 different elements. Shareholders' equity, long and medium term financial debts, operational debts, short-term financial debt. If you go to the other part, okay, it means the asset side. You find the non-current assets first, which include at the same time very different elements. All these elements can be called investments from an accounting point of view. It means all the land, production equipment, buildings, transportation equipment, but also intangibles like grants, like patents, for example, and also financial loans. You can be a company lending money, long-term loans, giving long-term loans, for example, to your subsidiaries. And this will be here in the non-current assets. So non-current assets can be a very large and heterogeneous segment in this analysis. The second one is the inventory. So we understand what is inventory with raw material, intermediate products, and also final products ready to be sold. You have got receivables, which are specific categories, and of course cash. Total assets should be below. Sorry for that presentation. So if I summarize, I have 4 categories on the right side, 4 categories on the left side. On the left side, I've got the non-current assets of investment. First, second, the inventories. First, receivable. Fourth, cash. On the right side, equity and liability side, I've got the shareholders' equity first, long and medium financial debts first, operational debt first, short-term financial debt number 4. I've got 8 categories, 4 categories on the left side, 4 categories on the right side. And that's a segmentation which will allow me to go through some other calculation and to introduce the question of equilibriums. So what are the main equilibriums in a balance sheet? This is the question raised here. And the answer is very traditional and simple. We have 3 different equilibriums in the balance sheet. The first one is what we call the net working capital. And be very careful, you can make calculation without understanding what is below. That means a good equilibrium or a good ratio should bring some kind of element of answers to a question. And the question here for the point number 1 of the slide number 13 on net working capital is what is net working capital, in fact? And the interest of net working capital calculation is brought by the first calculation here. Shareholders' equity plus long and medium financial debt minus non-current assets. What does it mean? It means we compare the long-term financial resources, which are made of 2 categories. The first one being, the equity, total equity, and the second one being, the long and medium-term financial debt. It means all financial resources which are supposed to be available for more than 1 year. And we compare these financial resources, we compare these financial resources to the amount of the investment, total investment, the amount of total investment. Okay. And we say, okay, let's make the difference. We have a total of long-term financial resources, which is here shareholders' equity plus long and medium-term financial debts. And if we take into account now non-current assets, is there something left? That means, when we have financed the investment, do we have still some resources, financial resources with more than 1 year maturity available? It means, can we finance at least part of the inventory and the receivable with resources which are with maturity more than 1 year? And you understand that if you finance at least part of your inventory and receivables with financial resources with maturity more than 1 year, you are in a safer position than if you finance this inventory and receivables with financial resources with 30 days maturity. So, very often banks like net working capital very positive because they think safer. No, they think they are safer. And that they are safer, that means their risk is decreasing. But at the same time, companies should not go too far, because you will understand, particularly in some of the sciences we do in the next session, that if it is too positive, it is very positive, absolute value will be high and it will be positive. What does it mean? It means you use equity and long-term resources, which are supposed to be more costly than short-term resources, to finance short-term assets, which in terms of return is not optimal. So we find again a case, which is kind of a traditional case in finance. If I increase my net working capital, it's safer for the banks, for the lenders. It reduces the liquidity and the solvency risk. But on the other side, if we go too far, it reduces also the different returns. So, you have to find levels which balance correctly these two measures, return and liquidity again. You understand also that this net working capital, just because the asset side, the total of the asset side is equal to the total of the shareholders and liability side. You understand that it can be calculated another way. If I take inventories plus receivables plus cash minus operational debt minus short-term financial debt, I will find the same number. So you have two ways to make the calculations. By the long-term resources and the investment, or by the current short-term, assets and resources. Second element, which is of great interest, and one of the interesting points is that the operating working capital is nearly not used in the US analysis, but it's used in nearly all the other countries in the world. That means at least in all the countries which have not adopted the financial American systems. What does it mean? It means we have in one part of the balance sheet, we have the comparison between the long-term resources and the level of investment. We will have kind of cash and treasury analysis on the other side. But between that, we have what we call the operations, the measures in the balance sheet, which represents, the operations. That means the inventory, the receivables, and the operational debt. Remember, we have the debts to the providers, to the staff, and to the tax administration. And if I make a calculation, which is inventory plus receivables minus operational debts, the result there is of interest. And we can have, of course, three different results. The first one, the most common one, is a positive result. It means inventories plus receivables are higher than the operational debt, and at the end we have a positive value. But what is this positive value? It is a financial need. If it's you have to finance the inventories, to finance the receivables, which are loans to the customers, and you finance them partly by debts you obtain from the tax administration, from the providers, and from your staff. But if it is positive, that means the level of the operational debt is not sufficient to finance the inventories and the receivables. So that means it has to be financed another way. We have to finance this amount which is left not financed, either by what? Either by the net working capital or by it means by the banks in general. So the operating working capital, when it is positive, is very often financed partly by the net working capital, which is the excess of long-term resources on the investment level, but is also partly financed by short-term loans coming from the banks. The problem is mainly the percentage. What is the percentage of the OWC, which is financed by the NWC, operating? What is the percentage of the operating working capital financed by the net working capital? And of course, what is the percentage of the operating working capital financed by the banks, short-term banks? And it is clear that when a company has substantially large operating working capital, very positive, and that this operating working capital is financed mainly by short-term loans from the banks. That means, the company is dependent from the decision of the banks. They are financed by short-term loans. It means perhaps the year after, the banks will not follow again the demand of loan from the company. And it is also generally costly because you have to pay interest to finance your operations. Do we know cases which are different? It means first cases with negative operating working capital. The answer is yes. Where do we find that kind of specificity? The main and good example, which is known all over the world, is the case of the distribution. It means supermarkets, hypermarkets, and each of you know what is a supermarket and hypermarket because sometimes you go there, to buy food or any other kind of product. What do you understand when you make a financial analysis of a supermarket or hypermarkets? You understand that inventories, in fact, are very, very low. When you go there to the hypermarket, you think that the level of inventory will be very important because there are so many products and categories in the warehouse, but you think that we find a large value of inventories in the balance sheet. That is not true. The inventory level compared to the total of the balance sheet, and of course, the level of sales is very small. Second, what about receivables? When you go on a Saturday, generally in a supermarket or hypermarket, you buy something, some articles. Generally, you pay at the end of the process. You go to the cashier and you pay either with cash or credit card. But that means they don't make credit. They are paid cash. So receivables is very close to zero. Can look at specific cases, but in general, it's very close to zero. But on the other side, for the operational debt, as many companies, and this is not very different from the companies on these points, they have got large amount of debts of VAT to the tax administration. They have also debts, holidays premiums to the staff. But they have mainly large amount of debts to the providers. Taking into account their market power, they pay very often 70 days, 90 days. That means the amount of operational debt is very important. It's much more important than the total inventories and receivables. And at the end, the operating working capital is negative. So if it is negative, what does it mean? It means that instead of showing a financial need, it is a financial resource. And of course, when you are a company in an economic sector which is showing negative operational, high operational debts and negative operating working capital, you have a source of financial resources which is at nearly zero cost. You don't have to ask to the bank. You don't have to go to the market and argue the questions in front of the questions of shareholders to issue new shares to get cash. You just increase your level of sales, and of course, your operating working capital and your financial resources and cost nearly zero would increase. So in terms of independence, in terms of cost analysis, it is the best position the company can have. And this is one of the successes of the modern distribution system. Of course, you can have situation of economic sectors with nearly zero operating capital, zero plus or zero minus. They don't show any kind of financial resources or any kind of financial needs there. But the policy in the companies on operating working capital, either to reduce the positive operating working capital or to increase the negative operating working capital, are constant. This is one of the main policy of CFOs. And you can say also, what's happened with this cash? Because negative position there is bringing cash. The counterpart of the negative operating working capital is an increase in the cash position. So generally, these companies, at the same time, they have resources with nearly zero cost, no need for banks and shareholders for obtaining new resources, but they get excess cash. And their problem is more what to do with the excess cash than any other. So excess cash means large amount of cash in their account. It means position of T here, which is cash minus short-term financial debts, which is very, very positive. So when you have an excess of T being positive, because mainly of the operating working capital, which is negative, the problem is what to do with the resources. What can you do? So you can pay back in advance your long-term loans if you have some of them. You can buy back shares, give back cash to the shareholders, or you can distribute, also increase the normal dividend and or distribute a super dividend. But you can also use this cash to make acquisitions. And one of the reasons why this economic sector is concentrating more and more is that the more profitable ones have got large amounts of cash available, and they can pay high price earnings, for the targets they want to buy. So we will see that again, in the M&A course. But a company with a large negative operating working capital is potentially a bidder, on the acquisition market. So this is what I wanted to present you in terms of equilibrium. And now just a small relations here. In number 14, slide number 14, two basic ratios. First one is that the treasury, of course, is equal to the net working capital minus your operating working capital, which is one of the easy conclusions of what I said in the last few minutes. You can make the demonstration using the second definition of a net working capital, which is inventories plus receivables plus cash minus operational debts minus short-term financial debts, which is the net working capital definition, minus the operating working capital, which is inventories, minus inventories, minus receivable, and plus, minus multiplied by minus is equal to plus operational debt. And when you find cash minus short-term financial debts, which is equal to T. So the treasury position of the firm is equal to net working capital minus the operating working capital. That means, of course, your policy in terms of operating working capital has an impact on the treasury. If your operating working capital is negative and the year after you're more and more negative, that means that it will bring something more to T. Because minus operating working capital is minus something which is minus something is equal to plus. And also, if you increase the level of equity, for example, issuing new shares, nothing else moving, you will increase your cash position. So this is some basic relation, but that makes it easier to understand some movements in the financial strategy of firms. And at the bottom of this part one here on that slide, you find DT equal D net working capital minus D operating working capital. What does it mean? It means if you do the same calculations, comparing 2 years, n plus 1, n, you will find that the modification of T is equal to the modification of net working capital minus the modification of the operating working capital. So the static relation, which is T equal net working capital minus operating working capital, static, can become more dynamic, introducing 2 periods of time. Now, a few basic ratios which are commonly used, commonly used. The first one is the net working capital divided by the sales level. And notice that in all these calculations, sales will always be without VAT. We will use sales compared to something different only for customers' credit, which means receivable divided by sales, and receivable being with VAT, sales taken into account will be with VAT. But here it is net working capital divided by sales. You get a percentage. For example, you will get 20%. Okay. That means that you can argue that your net working capital will pre-finance 20% of your sales. And of course, if you increase this ratio, it is safer and will reduce liquidity and solvency risk. On the contrary, if you decrease this ratio, you get more risk in terms of liquidity. So, remember, this is a problem of balance between liquidity and solvency risk and return management. And we have different optimal situation according to different economic sectors. However, if you have a look, many studies done on that, at the same time in financial research, but also in professional journals or even in central banks. If you are between 1/4, which is 25%, and 8%, 8% to 25%, you are in right segment. above, it's too much and your return will decrease. Above 25. Below 25, it is not enough and your liquidities and the risk are increasing very quickly. The second one is the operating working capital divided by sales. And this is very useful, you know, because it means that what is the amount of new financial resources we need to finance the operations for $1 increase in the level of sales. You understand that if it is positive, but very high, something like 40%, that means each time you want to increase your sale level by $1, you will need to find 40 cents of operating working capital, financial resources, excuse me, to finance your operating working capital. If your operating working capital is lower and the ratio is only 5%, that means each time you will increase your level of sales by $1, you will need only 5 cents of financial resources to finance your operations, operating working capital. And if the ratio here is negative, and it is negative because your operating working capital, for example, it's -5 when your sale level minus, let's say, 0.05 when your sales increase by $1. That means each time you increase your level of sales, you obtain new financial resources because your operating working capital is positive. That means all these companies with negative operating working capital, you know, their main strategy is to increase the level of sales. Because each time they increase the level of sales, they get new financial resources. They don't have to go to the bank to ask for loans. They don't have to ask new cash to our shareholders, just to increase the sales a bit. And they will do that by themselves. They will, in fact, create their own cash resources. The last one here is the net working capital divided by the operating working capital, which means you have an operating working capital, which is a financial need to finance your operations. How is it financed? I would raise a question. And when this ratio is very high, close to 100%, that means that nearly all the financial need coming from the operation is financed by the net working capital. It means it's financed by an excess of total equity and long and medium-term financial loans. And on the contrary, if net working capital of operating working capital is 10%, that means that 90% is financed by short-term loans from the bank, and the company is completely dependent from the banks. So again, you have a trade-off to find between dependence to the bank, cost of the loans on the one hand, and on the other side, the misuse of long-term financial resources, which can be allocated to investment and not to the to finance the operations. So this is also a first presentation, you know, on the balance sheet equilibrium. That's what I was able to do here. I've been through, you know, 14 of my slides. I have someone left and we use tomorrow in session number 2. You know, what I wanted to do today, I will make a brief summary at the end of each course, and at the beginning of the following one is first to make a short presentation of the course and with a simplified syllabus, was the first element. Second, to try to explain why, who, and how financial analysis is important. The third one is discussion on relation between finance and accounting. If you go to my documents, you will see a graph with a presentation on that topic, which is a main issue in finance. After that, I spend time, going through methodology with a certain number of steps, in simple case. And then the last part, we move to the balance sheets, first balance sheet structure, simplified balance sheets, equilibriums, static relation, dynamic relations, and part two discussion around the operating working capital base, which is very central in all the decisions of CFOs. That's what we were able to do today. So tomorrow we'll move to other topics. First, we have a small exercise which is contained in the slide 15 and 16. And I will go with you into some questions, basic questions which have been used several times in part one of several exams on the different concepts I introduced today. So I hope sometime I will get some questions, but because I know that we are 45 persons together, which means probably 43 students plus Mrs. Truelin and me. So 43, you should be able at least to find 2 or 3 questions in each session. I hope it will become more interactive than it was today. I understand it cannot be very interactive on the first session, but after that it can become more. And I hope that in the following courses, in the analysis of financial policy, in the evaluation, in the M&A courses, it will be much more interactive, That's a shame I don't see you in the classroom, but we know that circumstances don't allow you even to go to university, and I'm not allowed to fly to Vietnam at the moment. I hope that to have it before the end of the program, we'll be able to meet in Vietnam as we did for years with your colleagues of the preceding intakes. So I wish you a nice evening. It's already late for you. I hope you are still in good health. Take care anyway. The virus is dangerous, and then we have to fight against this virus altogether. Good night, and see you tomorrow, same time, which is 2 p.m. for me. It is 7 p.m. for you, for the second session of 3-hour session again. Goodbye and good night.